Hi guys, in this video I want to introduce a series of educational videos as well as my other videos. But in this video, these will just basically go down to the raw detail of how you can profit from the market using technical analysis or fundamental analysis. So looking at tools like the RSI, the MACD, and for instruments such as stocks, looking at the SEC filing, so Security Exchange Commission filing. So looking at how to look at balance sheets, etc. What information to look for to tell whether or not a company is actually doing well or could potentially do well in the future. So all of these tools and information, if used correctly, can make you a consistently profitable trader. So in today's video, I'm going to go through support and resistance and why I believe this is a key technique to learn if you want to be a profitable trader. And also I'm going to go through live chart data, basically showing you how you can use it in the real environment and how you can use it in a profitable way. But before I get into it, go ahead, subscribe, give us a like, give us a comment. What makes the market, any market, whether it's the forex market, the stock market, the housing market, what makes the markets move is fundamentally supply and demand. So let's say in the stock market, you say, I want to buy shares in Apple, for instance. So you're bringing that demand because you're looking to buy. And for you to be able to acquire any shares in Apple, someone has to supply you with those shares. So you're the demand and the counterpart is the supply. So the basics of any market is supply and demand. So if you want one share of Apple and someone says, I've got one share of Apple, and then the transaction is complete. So you take your share, the other person sells you the share, and that's it. But imagine you want to buy 10 shares of Apple and the other person looking to sell only has one share. So the fact that you've got a demand of 10 shares and there's only a supply of one share, you're creating an imbalance in the market. So an imbalance in the market is effectively when there's either more supply than there is demand, or there's more demand than there is supply. And this imbalance causes the price to actually move one way or the other. So if there's more demand than there is supply, it will cause the price of the security to go up, and vice versa. If there's more supply than there is demand, it will cause the price of the security to fall. So the supply and demand, or the imbalance of supply and demand, causes the market to move one or two ways. It can either be range bound, so it can either go between one point and the other and just continue like that, or it can be trending, so it can go up, retrace a little bit, keep going up like that, or come down, retrace a little bit, come down. So this could be a bullish trend or a bearish trend. So a bullish trend is when the market is moving up, and a bearish trend is when the market is moving down. So imagine Apple is currently trading at $100. I know it's not, this is just for the explanation's sake, but imagine Apple is trading at $100 and you want 10 shares of Apple at that $100. However, there's only one share available at $100, and at the $100 you've effectively created an imbalance of demand, which means that there's a lot of demand around that $100 line. So this imbalance that you've created has effectively caused the level of $100 to be a support zone. So this will cause the price to rise up. So whenever the price falls back down to the $100 line, there's likely going to be more demand. There's likely going to be more buyers thinking that, okay, that's the last point at which the price started rising. So chances are when the price falls to that level, the price is going to rebound. So let's flip the script. Imagine you want to sell, you've got 10 shares of Apple and you want to sell. Again, you want to sell at the $100 line, but imagine there's only demand for one share. So you've created effectively a supply imbalance. So that supply imbalance will cause the price to fall. But at that supply imbalance, because you've effectively offered more shares to the market than there are buyers available, then the price falls. When the price rises back to that $100, there's likely to be a lot of sellers waiting, because they'll be like, you know what, the last time the price was at $100, it fell. So there's going to be an imbalance in supply. So this will be a good time to short the market, or this will be a good time if your options trade. This will be a good time to buy puts. Your sentiment is that the price is going to fall. So what makes a support and resistance technique very powerful and very accurate? It's a self-fulfilling prophecy. So how you correctly identify a range bound market is that there's a power move into support or resistance. So this power move into support and resistance, so basically if there's a huge move into the support, or there's a huge move towards the resistance, so effectively the bulls are trying to test the resistance and the bears are trying to test the support. So if there's strong rejection at resistance, this means that there's a lot of sellers waiting to basically short the market, and you can bet that the price is very likely to come crashing down, and vice versa. If there's strong rejection at support, then you can pretty much bet that the price is going to start rising from that point on. So points number 3 and 4 basically just elaborate on this. So large candles going into support and resistance. So again, this is part of the power move into support and resistance, and large rejections. So the rejections could be bullish or bearish. Very popular candlestick patterns that indicate large rejection. On the bullish side is a bullish engulfing pattern, and on the bearish side is a bearish engulfing pattern. So I'll do a separate video going through the candlestick patterns, the formations, the ones to look out for, the most accurate ones or the most reliable ones to look out for. So just to give an example of these, so I've pulled up a chart of the USD JPY. So this is the United States dollar against the JPY. So this is a forex chart, and this works with stock charts as well. So the reason I pulled up a forex chart is that forex gets traded 24 hours a day throughout the week. So basically Sunday to Friday, forex markets are open 24/7. Because of this, you're less likely to see gaps. You usually see gaps when the market opens on a Sunday. Pretty much in between that, you don't necessarily see gaps. So if I have a look at the chart, we can see clear points of resistance and clear points of support. So there's different levels of support, but effectively the price has just been in a range bound from 11423 to 10805. Initially, when the price was falling, there's a power move all the way down. So at this point, there's a demand imbalance, which brings the price all the way up to test the resistance. But the resistance, again, there's a lot of sellers, brought the price down, and the bulls brought the price up. So this is what I was saying about a self-fulfilling prophecy. So everyone looking at this chart can see that the price is rising towards this resistance to test it, and they can bet that once the price gets to this level, that the price is likely to fall, and the price fell. When the price came back to this level, a lot of people, a lot of buyers were thinking, you know what, there's going to be a lot of demand around this area, or there's likely to be a lot of demand at this area. There was a lot of buyers, which brought the price back up to the resistance again. A lot of sellers jumped in and started coming, bringing the price back down to test the support. So they're effectively playing a game of tennis, so hitting the price from one area to the next and back, so back and forth. So we've looked at the range bound, so now looking at the trending market. So with the trending market, how you identify potential good entry points and exit points are power move breaking out of a resistance. So this is called a breakout. Power move breaking down is support, so this is called a breakdown. And the test of old resistance / support, and large rejections, bullish or bearish. Again, looking at the USD JPY, the bulls broke out of the main range at 104, so broke out of the resistance, and the bears brought it back down. So the bulls weren't giving up, so they tested this resistance again at 10432, and they broke out of this successfully. So pretty much from that point on, they went up to test 107 resistance. As you can see from this candle of the 9th of November, the bears tried to bring the price back down below this resistance, but there was a huge bullish rejection. So the bulls are like, nah, we're rejecting this, we're keeping this price going up. So as the price headed up to test 107 resistance, price broke out of the resistance at 107 and just continued going up. So this was a very strong bullish trend all the way up. You know, it would have been a bad day to be bearish at that time. So after the price rallied up, it made a new high, but the price came back down. Notice in the range bound example that I gave you where the price came down to 108. As you can see, 108 was the breakout of the previous resistance, and when this price came back down to test it, this was proven as a support. So old support becomes new resistance, and old resistance becomes new support. Guys, that's just an intro into support and resistance. And if this is something you like to see, maybe you're learning about technical analysis and the charts look just like a foreign language to yourself, and you just want to learn how to do it, make sure you guys subscribe, hit that notification bell, and also if you enjoyed this video, make sure you smash that like button. Thanks guys, I'll see you in the next video.